Welcome. Accounting and Management Made Simple is your channel of choice where we break down complex and difficult accounting and management principles into simple, understandable concepts. Whether you are a student preparing yourself for exams or a professional looking to apply knowledge practically, this channel helps you to grasp and understand complex key topics with ease. Please subscribe, share, like, and comment. Thank you. Hello, students. Today I want us to talk about accounting for sales and purchases. Accounting for sales and purchases. When you do business and you buy things and you sell, we maintain accounting records for your purchases and sales. And in accounting, there are terms which we restrict their use. There are terms in which we restrict their use. In accounting, when we talk about purchases, we mean purchase of inventory. And what is inventory? Inventory is what we buy to sell. If we buy and sell motor vehicles, our inventory is motor vehicles. Anything else we buy is not inventory. Anything else that we buy is not inventory. For instance, if we buy and sell motor vehicles, but we decide we're going to buy tables or vehicles, we buy tables for the office, or we want to buy motorbikes to help local lands as we do our buying and selling of motor vehicles, then the tables and the motorbikes are not inventories. Inventory is what we buy to sell. And therefore, the word purchase restricts itself to purchase of inventory only. Anything else that we purchase, we do not call it a purchase, we call it acquisition. And we know that in accounting, we can purchase in cash, or purchase on credit. We can purchase in cash or purchase on credit. And if we purchase in cash, our money leaves the farm, and we receive inventory. But because in accounting we do not maintain inventory account, we debit purchases. We do not maintain, and we credit bank or cash. In accounting, we do not maintain an inventory account. We therefore record the acquisition of inventory by debiting purchases, and we credit bank. When we acquire inventory on credit, the supplier supplies inventory to us on credit. We do not pay at that time, but we incur a liability. And therefore, again, we debit purchases because we are doing purchasing. We debit purchases account, and we credit trade creditors account. Now, please mark the entries that we make. Because they will guide us in terms of accounting for something called return inwards accounting. And we say return inwards accounting, it is when a customer who has, return outwards. This one will be return outwards accounting. Now, when a customer sells goods to us, the goods move into our farm. When the customer sells goods to us, the goods move into our farm. But if we realize maybe the customer sold us more goods that we wanted, or sold us goods which do not meet the specifications, they do not meet the specification that we wanted, then we need to return the goods back to the supplier. We return the goods back to the supplier, and we call that return outwards. We call it return outwards, and we need to account for the return outwards. When we return goods to the person who had sold the goods to us, either on cash or credit, we call it return outwards. We call it return outwards. And how we account for return outwards, it will depend on whether we bought the goods in cash or we bought the goods on what?
Credit.
On credit. Because if we return goods to somebody who has sold goods to us in cash, he will have to give us our money. He will have to give us our money, and we will also have to reduce our inventory. We will also have to reduce our inventory, and therefore we do not, remember, we do not maintain an account called inventory. We do not maintain our account called inventory. So we receive I like telling students this way. At times we don't know what to debit when we, in terms of return outwards and return inwards. But when we return goods to our supplier, we know money has increased into the firm. Because if we had bought cash, money will increase in our bank or cash. So you debit bank or cash. You debit what? You debit bank or cash because money is coming in. As we return goods, the money we had given is given back to us. But instead of crediting inventory, we do not credit inventory, we credit return outwards. We credit what?
Return outwards.
We credit return outwards account. We credit return outwards account. We credit return outwards account, and it's like we are reducing the cost of inventory. It's like we are reducing the cost of what? Okay. Inventory, and we accumulate all the return outwards that have been acquired in the course of the year, and instead of reducing the cost of inventory every other time we return the inventory, because we incurred cost when we had bought it, when we are preparing the income statement, instead of reducing the cost of inventory at the point of return, we accumulate all the returns into an account called return outwards, and we deduct from the cost of inventory only once in the income statement. So when you are preparing the income statement at the end of the year, we say less cost of goods sold, and we say opening stock, add purchases, less return outwards. Now, the goods we returned are not part of our purchases. The goods we returned, because we had bought them, but we returned them, they are supposed to reduce purchases. But we do not reduce purchases every time we return goods. We accumulate the return outwards in the return outwards account, and we only come to reduce purchases in the income statement. We only come to reduce purchases where? In the income statement. You only come to reduce. Remember. When we did the purchase, we debited purchases to record an increase in the cost of goods we have sold. We debit purchases to record an increase in the cost of goods we have done what? We have sold. When we return the goods back, we are supposed to reduce purchases. You're supposed to reduce purchases, but we do not reduce purchases in the purchases account. We accumulate that reduction in an account we are calling return outwards, and we only reduce purchases when we are preparing the income statement. When we are preparing what? The income statement. And that's the way to account for purchases. That is the way to account for purchases. Now, after you have accounted for purchases, then let us see how we account for what? For sales. Because we buy to sell. We buy to do what? We buy to sell. So let's see how we account for sales. Let's see how we account for sale. Accounting for sales. Now, how do we account for sale? We are saying that sale, in accounting, we mean only the sale of inventory. we only mean the sale of inventory. If you sell anything else, we call it disposal. We do not call it sale. We do not call it sale. We call it what? Disposal. And therefore, we say we can also sell or in cash or sell on what? Credit. You can sell in cash and sell on credit. Now, when we sell goods to our customers in cash, our goods reduce, but our cash increases. And an increase in an asset will debit the asset account. So you come here and we debit cash or bank. We debit cash or bank because it could have been given a check. We debit cash or bank as we credit sale. We credit sale. We credit what? Sale. When we credit sale, we are recording a reduction in inventory. We are recording a reduction in inventory because inventory is leaving the farm through sale. We are recording a reduction in inventory because inventory is leaving the farm through sale. Inventory is leaving the farm through sale. What about when we sell on credit? We create an asset called trade receivable or accounts receivable. Trade debtors or accounts receivable. And therefore, the asset of trade debtors increases, and an increase in an asset, we debit the asset account. We debit the what?
The asset account.
So trade debtors, we debit the trade debtors account. We debit the trade debtors account, and we are selling on credit. We are selling on credit. We're selling on credit, and therefore our inventory is reducing, and it is reducing because of sales. It's reducing because of what? Sales. It's reducing because of sales, so we credit sales. So we credit what? Sales. Now, the kind of sale we made, whether cash or credit, determines how we account when the customers return goods to us. When customers we had sold inventory to return goods to the farm, we call it return inwards. We call it return what?
Inwards.
We call it return inwards. We call it return. What is happening to return inwards? We are increasing inventory. When we return inventory back to us, we are increasing inventory. But we do not have an inventory account. We do not have an inventory account. So instead of debiting, inventory is returning to us, and therefore an increase in inventory and an increase in an asset, we debit the asset account. And because we do not have an inventory account, we debit return inwards. We debit return what? We debit return inwards with the increase. Whatever is returned, we debit return inwards, but it will depend whether it was cash. So if we assume it was cash sale, if it was a cash sale, we will debit return inwards, but we will refund the customer the money the customer had given us. So our asset of cash will reduce. And a reduction in an asset, we credit the asset account. So you come here and we credit cash. You credit what?
Cash.
We credit cash. We credit cash. When it was a cash sale, we debit return inwards to record an increase in inventory, because an increase in inventory or of an asset, we debit the asset account. So because we don't have inventory, we debit return inwards. We debit return inwards. And because we had sold on cash and someone had given us their money, now we are reducing our cash because we are giving away our money. A reduction in the asset of cash, we credit the cash account. We credit the cash what? Okay. What about if we was a credit sale? What if we had sold to the customers on credit? We had sold to the customers on credit. Inventory will still increase. Inventory will still do what? Increase. So we will debit return inwards. We will debit what? Okay. We will debit return inwards to record increase in inventory. To record increase in inventory. Because we do not maintain an inventory account. Because we do not maintain an inventory what? Account. But when we were selling, we had not recorded cash, we had recorded debtors. We had recorded what? Debtors. Because we had recorded an asset of debtors, 3 debtors, now we reduce that asset. And a reduction of an asset, we credit the asset account. We credit the asset what? Account. So we come here and we say credit trade debtors. We say credit trade debtors. We say credit trade debtors. We credit trade debtors. We credit trade debtors. We credit trade debtors. That is how to account for sales and sales return. That's how we account for purchases and purchases returns and sales returns. Once again, I want to request you to subscribe, to like, to share, and to hit the notification bell so that every time we are loading this kind of a video, we will be able to notify you. Thank you very much.